something extraordinary just happened in the silver market. Within hours, prices violently swung, wiping out gains, triggering panic selling, and leaving millions of investors confused. This was not a slow correction. This was a sudden shockwave that moved through the global financial system faster than most people could react. In a single trading session, silver experienced one of the most aggressive price swings seen in recent history. Charts showed sharp vertical movements, massive volume spikes, and sudden liquidity gaps. These are not normal conditions. These are signals that something deeper is unfolding beneath the surface of the financial system. To understand what really happened, we need to look beyond the price itself. Silver is not just a metal. It is a financial asset, an industrial commodity, and a strategic reserve. When silver moves violently, it often reflects stress in multiple parts of the global economy at the same time. One of the first triggers came from activity inside the futures market, particularly on the COMEX, which is operated by the CME Group. This is where most global silver pricing is determined. When large institutional players enter or exit positions suddenly, it can cause dramatic price movements within minutes. During this recent event, trading volumes surged far above normal levels. This suggests that major participants, including hedge funds, banks, and algorithmic trading systems, were actively repositioning. These entities control enormous amounts of capital, and when they move together, the impact can be explosive. Another factor contributing to the shock was the strengthening of the US dollar. When the dollar rises rapidly, precious metals often face pressure because they are priced globally in dollars. As the dollar gained strength, silver became more expensive for international buyers, reducing immediate demand. At the same time, rising bond yields created additional pressure. Higher yields offer investors an alternative to holding precious metals, which do not generate interest. As yields climbed, some investors shifted funds away from silver and into government bonds. But this explanation alone does not fully account for the speed and magnitude of the swing. There were also signs of forced liquidation. This happens when traders who borrowed money to buy silver are suddenly required to sell when prices fall, triggering a cascade of automatic selling. This cascade effect can accelerate declines dramatically. Each forced sale pushes prices lower, which triggers more forced sales. This creates a feedback loop that can cause extreme volatility in very short periods. There is also growing evidence that algorithmic trading played a major role. These automated systems react instantly to price changes, executing thousands of trades per second. When certain technical levels break, algorithms can amplify movements far beyond what human traders would normally create. At the same time, physical silver markets are showing very different signals. Reports from dealers indicate strong physical demand, tight supply, and increasing delivery delays. This creates a disconnect between paper prices and physical reality. This disconnect has been building for years. The paper silver market, dominated by futures contracts, represents claims on silver that often exceed the amount of physical metal available. This means price movements can sometimes reflect financial positioning rather than physical supply and demand. Central bank policy is another critical piece of the puzzle. The Federal Reserve has been signaling uncertainty about future interest rates. Every hint, statement, or economic data release can trigger massive repositioning in financial markets, including silver. Investors are constantly trying to anticipate the next move. When expectations suddenly change, markets react instantly. This reaction can produce sudden spikes and drops, exactly like the one we just witnessed. Geopolitical tensions are also playing a role. Global uncertainty increases demand for safe haven assets like silver and gold. But at the same time, sudden shifts in risk sentiment can cause temporary selling as investors move into cash. This creates an environment of instability. Prices can move sharply in both directions, not because silver has lost its fundamental value, but because financial flows are rapidly shifting. There is another important factor that most people do not see. The silver market is relatively small compared to other financial markets. This means it takes less capital to move prices dramatically. When large institutions adjust positions, the effect is magnified. Even a small percentage change in institutional allocation can produce massive price swings. This is why silver is known for its volatility. It can rise faster than gold during bull markets, but it can also fall faster during corrections. What makes this recent event particularly significant is the speed. The entire move happened within hours. This suggests coordinated activity, forced liquidation, or sudden changes in institutional positioning. Another signal to watch is open interest, which measures the number of active futures contracts. Sudden changes in open interest often reveal whether new positions are being created or existing positions are being closed. Early data suggests that both liquidation and new short positions played a role. This combination can create powerful downward pressure. At the same time, long-term fundamentals remain strong. Silver is essential for industrial applications, including solar panels, electronics, and electric vehicles. Demand from these sectors continues to grow. Supply, however, is not increasing at the same pace. Mining production faces constraints, rising costs, and declining ore quality. This creates long-term structural pressure. This imbalance between supply and demand supports higher prices over time. But in the short term, financial markets can override fundamentals. This is why sudden shocks like this can occur even when the long-term outlook remains positive. Another factor is investor psychology. Fear spreads quickly. When prices drop suddenly, many investors panic and sell, even if fundamentals have not changed. This emotional reaction amplifies volatility. Markets are not purely rational. They are driven by human behavior, expectations, and fear. Institutional traders understand this. They know that sudden moves can trigger emotional reactions. This can create opportunities for profit. There is also increasing discussion about market structure. Some analysts believe that paper markets suppress price signals temporarily. Others argue that volatility is simply a normal part of price discovery. Regardless of interpretation, the result is the same. Investors experience sudden and sometimes shocking price movements. This recent event serves as a reminder of how fragile financial stability can be. Markets can change direction instantly. It also highlights the importance of understanding risk. Silver offers opportunity, but it also carries volatility. The key question now is what happens next. Will silver recover quickly or will volatility continue? Early signs suggest that stabilization may occur once forced liquidation subsides. When selling pressure ends, prices often rebound. Physical demand could also provide support. When prices fall, buyers often step in to acquire metal at lower levels. This creates a floor under the market. Over time, fundamentals tend to reassert themselves. However, volatility may remain elevated. Global uncertainty, central bank policy, and financial positioning continue to create instability. This means investors should prepare for continued price swings. What we witnessed was not random. It was the result of multiple forces interacting at once. Currency strength, bond yields, algorithmic trading, forced liquidation, and institutional repositioning all played roles. Together, they created the perfect conditions for a shock. Understanding this helps explain why the move was so sudden. It also shows why silver remains one of the most dynamic markets in the financial world. Moments like this often mark turning points. They reveal underlying stress, hidden risks, and shifting power dynamics. For investors who understand these signals, volatility can provide insight. For those who do not, it can create confusion and fear. The silver market is sending a message. The message is that financial stability cannot be taken for granted. Markets are entering a period of heightened sensitivity. Small triggers can produce large reactions. This increases both risk and opportunity. The coming weeks will be critical. Investors will watch closely for signs of recovery or further weakness. Institutional positioning will play a key role. Central bank signals will also influence direction. Every economic report will matter. Every policy statement will be analyzed. This environment creates uncertainty, but it also creates potential. Silver remains deeply connected to both financial and industrial systems. This dual role makes it uniquely sensitive to global conditions. The recent shock is not just a price movement. It is a signal that deeper forces are at work, a signal that markets are adjusting, a signal that volatility is returning. And for those watching closely, it may also be a signal of what comes next. Right now, attention is shifting toward what institutional investors will do next. If large funds begin rebuilding positions, silver could recover rapidly. If they continue reducing exposure, volatility could persist longer. Monitoring volume, open interest, and delivery demand will provide essential clues. Another important signal is physical delivery requests. Rising delivery requests indicate confidence in physical ownership. Declining requests may signal weakening conviction. These trends reveal underlying sentiment. Investors should also watch currency movements carefully. A weakening dollar often supports higher silver prices. A strengthening dollar can create pressure. Currency dynamics remain central to precious metals behavior. Economic data releases will also influence direction. Inflation reports, employment data, and manufacturing indicators all affect expectations. Expectations drive positioning. Positioning drives price movement. This is why the coming days and weeks are critical. Markets are at a sensitive point. Small developments can trigger major reactions. The recent shock has captured global attention. It has reminded investors that silver remains volatile, reactive, and deeply connected to financial conditions. But it has also reinforced silver's importance. It remains a strategic asset. It remains a monetary asset. It remains an industrial asset. And its story is far from over. The next major move could define the trend for months or even years. Investors who understand these dynamics will be better prepared, calmer under pressure, and more capable of recognizing opportunity when it appears in moments of uncertainty and financial change. And if you want more sharp updates like this on boring currency, subscribe and comment boring currency so I know you're part of the community. This video is for education and discussion only. I'm not your financial advisor. I don't know your personal situation, and nothing here is a buy or sell recommendation. Do your own research and think for yourself. Stay safe.